All right, folks, welcome back. I do hope everyone's doing well. So we're looking at episode 12. This lesson and lecture is going to be on the topic of market structure for precision technicians. Now, admittedly, going into this is an advanced price action theory. All right, here is the NASDAQ March contract for 2022. In here, we're going to take a deep dive into that price action right there. All right, so we are looking inside that fair value gap on the daily chart. This was the high end of that fair value gap, and this was the low end of that fair value gap. The time frame on this chart, as you can see here, 1 hour, and I've outlined market structure in the idea of long-term high, long-term low, short-term high, short-term low, and in between those two swing points, there's an intermediate term high and an intermediate term low. When we look at price, we're not looking for just the simple higher high, higher low, therefore it's a bullish market or uptrend. That's not what I'm looking at. I'm looking at, does the market have a reason to go up for buy-side liquidity or buy stops, or is it likely to go up to rebalance an imbalance, which is like a fair value gap? Or is it likely to go lower to sweep out short-term lows for sell-side liquidity or sell stops? Or is it likely to go down to rebalance an old imbalance or a fair value gap below market price? That is the number one question that I have before I sit down in front of my charts. That's what I'm looking for. What is the current market narrative? What is it likely to be doing right now? Now, how do I arrive at that idea? Is it going to go higher or is it going to go lower? Because that kind of leans on that question I told you many times. If there's one question I get asked the most, it's teach me bias. In other words, you want to know, where's the market going next? And that's good. That's the next draw on liquidity. But the daily range will not always submit to that bullish or bearish, right from the opening go higher or right from the opening go lower. Sometimes you'll have consolidation intraday, and you may have been trying to take a trade that was based on an idea that you came to that would be bullish. And maybe it did give you an opportunity to be in a trade that was profitable for a period of time, but you held on to it thinking the daily range was going to keep on going higher, and it turned on you. These ideas I'm going to teach you in this lecture here will help you identify the likelihood that your idea is probably been proven inaccurate, but you have to be receptive to the clues that price is giving you. So right away, we know that price is traded up to the high end of that fair value gap. And again, this level here is that daily chart. Let me go back up one chart. That's this level here. Okay, it's on this candle, that low. And the low of the fair value gap is this candle's high. Dropping down into the hourly chart, that's the high end of the fair value gap. This is the low end of the fair value gap. Again, on an hourly chart. So that way we have our bearings. So when the market traded up into and just above that fair value gap high, once it started to break down and go lower, it traded back down into this candlestick's high. So we're trading back inside this range, and we're range bound. Since I am expecting the daily chart to be parent of this price structure, all minor lower time frame swings are going to be subordinate to it. And what does that mean? This now is a long-term high. I do not expect this high to be broken to the upside. Should it be broken to the upside, that means that my daily analysis, expecting this level here to hold price and to be a factor in the algorithm repricing and going lower at a later time, if it goes above that, then I'm probably wrong in my analysis. So therefore, I demand more information by studying more price action and sitting on my hands. But as long as price remains below this high, my idea is this is a long-term high. Because it's framed on what? A higher time frame resistance level, if we want to talk in terms of retail ideas, so that way we can understand something in a simplistic manner, but we'll build on the ideas that will help move you away from simple support resistance ideas. So this long-term high should remain intact. In other words, price should not go higher than that. We trade down to the discount level of the low end of that fair value gap, and it starts to find support, rallies back up, trades near the high, but does not take that out. Very important. Once it starts to break down and consolidate, in here, retail ideas will see a lot of trust in the idea that's potentially a bull flag. I love seeing those patterns because I like to fade them. So that's a false bull flag. And when we see price break down like this and then rally back up, every single time price rebalances an imbalance, like we have this candle's low, this candle's high, we have that one single candle passing down like that. Once that rebalances by going up here, that swing high from this high, and this high, that's a swing high right there. Every rebalance of an old imbalance, that swing that's created at that moment, I immediately label that in my mind as an intermediate term high, or in this case, as we came back down and filled in this by dropping down here, That's an intermediate term low. What does that mean? What's the significance of that? Typically, what you'll see is an intermediate term low has a higher short-term low to the right of it and a higher short-term low to the left of it. This intermediate term low forms by rebalancing, but it has a higher short-term high here, but then the market trades over here off of this short-term low. It rallies up, but it fails. It fails in here. What is it indicating? What is it showing? The market has traded higher and then consolidated. We failed to go above this important high back here. That's a long-term high. Then we have an intermediate term high. Why? Why is this an intermediate term high? Because we have a short-term high here and a short-term high here. So between two short-term highs, the highest high between those, that's an intermediate term high. But the main takeaway for your notes so far is anytime a imbalance, like this big candle up, is rebalanced, that becomes an intermediate term low. Just as well on the opposite end, this down move here, that's a fair value gap. As soon as it rebalances there, that's what I classify as an intermediate term high. Now here's where we take a huge step forward. Classically defined by Larry Williams, that idea of his approach to market structure, he teaches a little bit of it in this book. They were taught in a early work by him in regards to market structure, how to internalize price structure, how to look at price not just from a higher high, higher low, because that's too myopic. It's a pursuit of simplicity, not for the sake of getting to the truth or the heart of the matter. For an additional view on how I built this understanding in price action, it originally came from his idea of market structure. So when you hear people talk about market structure and they're looking for a higher high, higher high, higher high, and having successive lower lows behind them, and then you have a failed higher high, and then it breaks the swing low right before that failed higher high, they look at that as a change in trend. Not all the time. Many times that's a good buying opportunity for me because really that's just coming back down into a deep discount and I'm going to buy those and continue it higher. So it's a little tricky if you don't understand the higher time frame, which is what those red levels are. That's higher time frame. The hierarchy in parent to child price swings is directly linked to the order flow on those higher time frame charts. So in other words, what am I saying? The daily chart has the bulk of the volume that's coming into that marketplace. There isn't a lot of volume coming in on a 1 minute chart. That's not to change the importance or reduce the importance rather of a 1 minute chart within the proper context and market structure that's underway. So you can use a 1 minute chart to navigate because as a smaller retail trader, which is who we all are, but we don't trade with retail logic. There's a separation from what we're trying to do in price versus the collective out there that learns from books and things like that. I want to take you into the chart now and show you what he's not teaching in that book, what he hasn't taught in any of his works, and it gets a little bit closer to the heart of the matter. So if we have a imbalance that's rebalanced and we have an intermediate term high, shouldn't an intermediate term high have a lower short-term high to the right of it and a lower short-term high to the left of it? Yes. What I discovered in my own study, the idea of a intermediate term high not being higher than the short-term high to the left of it or the short-term high to the right of it. In other words, it's going lower. An ideal scenario should be this high should be above both short-term highs, but it's not. So what is it doing? It's only rebalancing this, and where is it likely to go? As soon as this candle starts to go up like this candle and this candle. Why not this candle too? Well, this candle only has this low here. This candle is an up close, but this starts the last two up close candles right before this move down. This is important because we're going to look inside this shaded area and how we can use highly precise ideas within this order block. I'm anticipating this run up with these candles forming an order block where everyone else is teaching the idea of the last up close candle before the down move. That is not my order block. This movement here, these two green candles that are going up, I'm watching these as they form live with the expectation, because this imbalance has been rebalanced here, this swing high is an intermediate term high. I do not expect this high to be taken out. So I'm already forecasting and anticipating a failed price swing in here. Every time this green candles are forming, I'm looking at that as a bearish order block. So from the beginning at that candle's low, I'm looking in time on lower time frame charts. I dropped to a 15-minute time frame. Now, before I get any further, just know that the range between this long-term high and this long-term low, that range is going to be used for targeting purposes. And I'll get into that in a moment. But these up-close candles, from the hourly perspective, that's the range for my hourly order block. Inside that range, I can be hunting fair value gaps. I don't need to see the market trade down below the last highest up-close candle. Before I zoom in, look closely. What do you see? Right in here, you can see a small little imbalance. This one single candle like that, right there. That's the same thing that was occurring in this move here on the hourly chart that gets rebalanced there. Here, we have a smaller version of it. That is a fractal. That's something that repeats on a smaller or higher time frame that's similar in its formation. It won't be identical, but it's closely related to the general idea. If it trades back to this candle's high, that's your entry right there. That's aggressive, but there's also an imbalance in here, and it rebalances that right there. Now, once we establish the market structure on that hourly chart, I'm not going down into the lower time frames below it and marking out all the swing highs and swing lows either. That's overkill. I just need to know what I'm looking for on the time frame I'm trading on. The logic is based on that daily chart that it's going up into this imbalance to go lower. The hourly chart frames my trade. It gives me what I'm looking for to start hunting entry techniques. But I might not like the risk parameters that's required on this time frame, so I can go down into the lower time frames. Should price go lower and break lower, I'm looking at that short-term low here and that intermediate-term low there. If we have a short-term low taken out and an intermediate-term low taken out, or just an intermediate-term low taken out, then we can go back to the previous long-term high, long-term low. Now, a long-term high and long-term low is generally going to be linked to a higher time frame daily chart. There's lots of ways you can frame your trade, but you have to have something directly linked to that daily chart, because the daily chart, that's exactly what institutions are working off of. That's exactly what banks are working off of. That's where the money is. That's where your bias is going to be determined. That's going to be what makes or breaks your trend continuation, that daily chart. So if we have a break below an intermediate-term low, then we have what? A significant break in market structure. This is something that's more significant just simply than going into a chart saying, okay, well, it took out a short-term low, there it is. See how much more detailed this is? What this tells me is, then I can start using this range, high and low, and start getting projections down. I can get a measurement of measuring this high to this low and start replicating that going down. And it'll give me price targets. They're generic price targets. If price breaks below here, as it does here, you can simply take your Fibonacci, anchor it to the highest high, down to the lowest low, and this is what you would get here. Why am I using that? Why am I not using this here to here? Because this return back up, this is where all of this move starts right there. This is just the beginning of the framework. This is where the swing begins on the decline. Follow what I'm saying? I'll say it again. This high and this low, that's your framework. The retracement that fails, that starts the decline, begins here at that intermediate-term high. So if you anchor your fib to the intermediate-term high down to that low, which is a long-term low, the projection is negative 1.5 standard deviation, and there's your low. How much lower than this can it go? That's one way of determining it. I got requested to teach market structure, and this is my interpretation of market structure because I'm leaning on algorithmic principles that are in the marketplace that can't be taught to you, but I'm creating a language so that way you can see it visually in your chart and you can measure and reference certain things. Not exactly like the algorithm does, but very, very close to what it's doing. So if we're looking at this little shaded area here, I want to zoom in now and get down to the heart of this teaching. This is the same 15-minute time frame. I'm just zooming in a little bit more. This is an aggressive entry for going short. Now, that hourly chart was showing those two candles going up. In the 15-minute time frame, it's obviously more candles. So in this up-close candle series, in that range, if I get a fair value gap form with a breakdown like this, notice I don't need a swing low broken. On the model I'm teaching you, you have to look for what? The short-term low being broken. That's your market structure shift. Then you see price go up into that imbalance and then you can go short, or vice versa when you're going bullish. If you understand market structure with this perception, if the intermediate term high is not higher than two short-term highs, that is telling you that the market is very weak and the algorithm is tipping its hand to those people that are looking at it like this. Why is this an intermediate term high when it didn't even rebalance anything? Here's a long-term high. Here's a swing high over here and a swing high over here. See that? Long-term high, right? Intermediate term high, short-term high, short-term high, or if you want to use this one, I'm using this one, not classifying this one because this is energetic. It moves lower. You could have easily had a short-term high marker there, but I'm using this one because it has that run lower to rebalance. So intermediate term highs, there's two classifications. It is a short-term high that has a lower short-term high to the left of it and a lower short-term high to the right of it. Or, and this is the main one here, it trades back up to rebalance and imbalance. That immediately becomes an intermediate term high. Now, the usefulness of that is if we're bearish and it rebalances like this, the next short-term high should be lower than that intermediate term high. If it trades higher than that, then your trade idea is probably flawed. Don't force that trade. Wait for market structure to get back in sync with what you're expecting, something bearish. That's how you keep from blowing your account or forcing your will in the marketplace. Now let's go back into the order block. Inside these candles as it's going up, I'm looking at lower time frame charts, and this is a 15-minute time frame. We see it break down. It doesn't take any short-term low out, but it's inside these up-close candles, which is an hourly order block of two candles. the imbalance, trades up into it, that's your aggressive sell. Your stop could be right above that high. The classic low risk, high confirmation short entry is the classic return back to an order block after a trade down below it. Here's your little gap, trade into it, here's your short. Where's your stop? Above this candle's high. You can go down into the charts deeper with your 5, 4, 3, 2, and 1, narrowing down to a smallest time frame. You can see that the last two candles here, wait for the turn, inside the order block. But these last two candles here, with the gap, that low is exactly to the quarter point as that candle's high right there. Why am I pointing to that candle? Because the order block is one consecutive series of up-close candles. It's not the last candle before the down move. The imbalance here, it goes over a little bit, that's okay. But inside this range in here, more specifically, the order block, the hourly right here, that's where your fill would be, or aiming with your limit order. And the heat on the trade would be on this candle's movement there, but your stop will be above here. But you're aiming for a very large downside objective. So the risk from entering here at the bottom of the hourly bearish order block, which is again represented by the bottom of that rectangle here, you're entering there. The heat or the drawdown in the trade is limited to just that candle, but your stop has to be here. And you're expanding lower for a target that's many times over what your risk is. Dropping down to a 4-minute chart, here's that same order block from the 5-minute perspective. It's a little skewed now because we're looking at 4 minutes. Each candle's 4 minutes in duration. Market trades up into that, hits it perfectly. Not that it's linked to anything on the 4-minute chart, but it's linked again to that 5-minute chart. Hits it right there beautifully, trades lower, comes right back up, trades into the top end of that fair value gap on the higher time frame before we start dropping down. Sometimes you get this little coloring outside the lines, and that's okay. That's a matter of experience and time studying it and doing it. You anticipate a certain measure of imperfection. It's likely to do that, and if it does, don't freak out. Then the market trades lower and reaches for those targets. Now, what I want you to think about is when you see these patterns for entry, the idea is this. When you see an imbalance get rebalanced, the high formed as it rebalances, that high should not be violated by price going higher than that if you're bearish. If you blend that with institutional order flow, what is institutional order flow? When you're bearish, all of your up-close candles should keep price from going higher than them. Watch what happens. Market breaks lower, so we have up-close candle and up-close candles. The market trades higher, yes, but does it overtake this up-close candle? No, it just trades back up into it a little bit, but doesn't go above it. That's important because if it doesn't overtake these up-close candles here or here, it doesn't even need to get to these because it hasn't even overcome this one. So it acts as real resistance. That's institutional order flow. Your market, when it breaks again from the consolidation in here, all of these up-close candles never get reached into again here at all. But notice what we've got over here. We have up-close candles. The market leaves it. Then it comes right back up. Does it overtake these up-close candles? No, so it's going to remain heavy. So in short, I've taught you tonight to look at the markets from a market structure perspective by breaking down the price swings, labeling them, specifically an imbalance that's rebalanced. That intermediate term high or low should not be violated. That's a key high or a key low. That sets the stage for a market move that should unfold and deliver to a higher time frame objective. While the market is moving in your favor, you're going to continue to trust that move and hold on to your trade because if you're bearish, up-close candles should keep price below it. They're speed bumps. They may come back up and touch them and act as a what? Bearish order block. But you do not want to see them traded above if you're bearish. And vice versa. If you're bullish, when price is moving higher, generally the candles will be predominantly green in my case because I'm looking at green candles when it's going higher. But down-closed candles should support price. If it trades back down to them, it's going to act as a support structure for an order block. So I've given you two main components to market structure and institutional order flow. How to know when the move is still good and not be afraid. And how do you know when the move is likely to be dynamic? And how do you know when the idea is probably flawed and your interpretation or your analysis is wrong? This brings this lesson to conclusion tonight. And I am absolutely certain that you have a litany of questions and concerns and confusions. All of those things get answered over time. Spending time with me, looking at examples, and you'll see it over time. It cannot be understood in one lesson.